Covered call ETFs have exploded in popularity in the last few years, and especially so far in 2025. And this year, I actually built out the Dividendology covered call ETF database that provides in-depth data on over 65 different covered call ETFs, which you can actually download for free at the link in the description. And while there's plenty of different options when it comes to covered call ETFs, two of the most popular covered call ETFs that for the most part track the S&P 500 are JEPI, the JP Morgan Equity Premium Income ETF, as well as a newer fund, the NEOS S&P 500 High Income ETF, SPYI. And while JEPI's now existed for a little over 5 years now, SPYI has only existed for around 3.5 years. But as both of these funds have existed for just a little while now, we can start to gain more insights and look and see where we see discrepancies and which fund has actually been performing better. So let's go ahead and dive in and compare these two funds. And to start, let's make sure we have a basic understanding of JEPI and SPYI. If we jump over to the JEPI fact sheet, we can see they generate income through a combination of selling options and investing in US large cap stocks, seeking to deliver a monthly income stream from associated options premiums and stock dividends. Okay, to start, that's pretty similar to SPYI. Down here they state they seek to deliver a significant portion of the returns associated with the S&P 500 index with less volatility in addition to monthly income. Now, there's one more statement they make, but we'll come back and look at this in just a moment. First, let's look at SPYI, and we can see there's some similarities. To start, they aim to generate high monthly income by investing in the S&P 500 index and implementing a data-driven call option strategy. And they aim to capture a portion of the S&P 500's upside when the index rises. Again, fairly similar to JEPI. But here's where we start to see our first discrepancy. If we zoom back in on JEPI, they state they construct a diversified low volatility equity portfolio through proprietary research process designed to identify over and undervalued stocks with attractive risk to return characteristics. This is different than SPYI. SPYI holds all 500 constituents of the S&P 500. Meanwhile, JPEI, while they do focus on S&P 500 stocks, the fund managers primarily try to focus on stocks that they believe have good risk to return characteristics. This is incredibly important to make note of, especially with the type of market that we've seen in the last year. Yes, the S&P 500 is up around 13.03%, but we have to understand this is an incredibly concentrated market, which is actually something I was pointing out over on Dividendology.com just the other day. But if we look at where the gains from the S&P 500 are actually coming from so far this year, just 4 stocks, Google, Nvidia, Broadcom, and Microsoft, are essentially driving half of the gains of the S&P 500. And if you include the rest of the top 10 stocks, they actually account for more than 50% of all the gains. So with SPYI's strategy, they did get exposure to those stocks. With JEPI, that wasn't necessarily the case, and we can really see this if we look at the total returns over the last year charted out. The total return of the S&P 500, again, remember, this would include dividends or distributions, but they're up by about 14.4%. Meanwhile, JEPI is only up 3.94%, and SPYI is up 13.53%, closely following the S&P 500. Now, we have to remember, covered call ETFs are not designed to outperform their underlying holdings. That happens on occasion, but it's rare, especially in bull markets. And if we take a close look, we actually can see there was a point in time this year where JEPI was outperforming the S&P 500 and SPYI. It was before the April tariff scare. But after that, a huge bull run started, and we really started to see a wide divergence in the performance of these ETFs. So while we could sit and argue which of these strategies is better, it's clear SPYI has had a bit of an advantage, especially with just a few stocks driving nearly all of the returns. Now you might be thinking, okay, total returns are obviously important. We all want to see great gains, but I'm primarily focused on distributions. Well, let's analyze that. And this is where things really start to get interesting. If we look at SPYI and their trailing 12-month yield, what we can see is their yield is about 11.61%. Let's compare that to JEPI. if we look at JEPI, we can see their trailing 12 months yield is sitting at about 7.47%. That's certainly considerably lower than SPYI. Now, one of the important notes we have to make here is that the distributions from covered call ETFs are paid out of net asset value. Let me show you an example of what I mean. Again, this is something I was writing about on dividendology.com just the other day. Be sure to check it out at the link in the description. But let's use QYLG as an example. If we just quickly scroll down, we can see at 2 points in this fund's history, they made massive distributions. Why was this the case? Well, basically to avoid being taxed at the corporate level, the fund must distribute at least 90% of its taxable income and realize capital gains to shareholders each year. So basically, if the fund realizes additional capital gains from selling appreciated stocks and those gains push its total taxable income above what's already been paid out, then it's legally required to catch up by distributing the remainder before year end. So obviously, QYLG has seen this happen twice in its fund's history. But if you pay close attention to what actually happened with the share price, you can see when these distributions were made, there was a large drop in the net asset value. Now, how does this relate to JEPI and SPYI? They haven't been in a similar scenario, but what you have to understand is when you see those share price declines, it makes it more difficult for them to sustain large distributions. So even though JEPI's share price hasn't seen a massive decline in the last year, down by about 4.27%, it does make it more difficult for them to sustain large distributions. Meanwhile, SPYI in the last year is essentially flat when it comes to their net asset value, meaning it's a little bit easier to maintain those distributions. In fact, let's use ticker data to automatically import the distributions into this spreadsheet. Let's start with looking at JEPI. Again, with ticker data, their entire distribution history will load into my spreadsheet. So let's take a closer look at this. Now again, JEPI has a little more history than SPYI, so that's something we do have to keep in mind. It looks like those distributions were sitting close to around 45 to 50 cents per share. And remember, that's on a monthly basis, but there's a wide variability in the amount they pay out every single month. Look at this. For example, in December of 2020, they paid out around 54.28 cents, and the very next month, that distribution dropped to just 26.26 cents. That is a wide variance. Now, you may have different needs than a lot of people, but in my mind, if you're someone looking for income, you want it to be predictable and you want it to be stable. A 50% drop in your income month over month is not ideal. Now, it stayed in this low range for a while, saw a wide increase, and then dropped pretty considerably again. And over the last few months, it's been more in that 35 to 36 cent range, which is a little bit lower than they initially started. Now, let's look at SPYI. Now again, their distribution history isn't as extensive because they didn't make their first distribution till around September of 2022. But immediately, without even taking a deep dive into these distributions, we can see there's a lot more stability, and overall, the distributions actually haven't declined. For the most part, it's been in that 50-cent range, and we can actually see that their last few distributions have been higher than where they started around 3 years ago. That's pretty rare for covered call ETFs. Now, as I was analyzing the distributions for each of these funds, I decided I wanted to take it a step further. So again, I used ticker data to import the financials into my spreadsheet, found the change in distribution every single month for SPYI and for JEPI, and naturally, I charted it out. And this was perhaps what was the most eye-opening to me. As we already saw, SPYI is considerably more stable versus JEPI when it comes to distributions, but the visual really makes that clear. We can see for both of them since around November of 2022, JEPI has seen drops month over month of around 22%, 19%, 29.7%, 26%. Now, yes, there will be spikes up month over month, but like we just saw, it's still not getting them back to where they previously were when the fund was created. So far, it looks like SPYI has had a bit of an advantage over JEPI when it comes to things like total performance, distribution yield, and the month-over-month volatility of the distributions. Even if we zoom out and look at total returns over a 3-year time period, obviously they both underperform the S&P 500. These are definitely not long-term growth strategies. But even then, SPYI significantly has outperformed JEPI. Now, what's interesting is despite this, if we look at assets under management for SPYI, it's sitting at about $6.3 billion, which is still significant. That's higher than a lot of covered call ETFs, but JEPI is sitting at over $41 billion, nearly 7 times more. So what else is there to take into account? Well, there's a couple of different things that we could point to. To start, JEPI does have a lower expense ratio. There's a 0.35%, while SPYI is 0.68%. Now, obviously, past returns don't guarantee future returns, but I do think anyone would be willing to pay a slightly higher expense ratio for the type of outperformance that SPYI has had versus JEPI over the last 3 years. Now, let's account for taxes. And this is where a lot of people have questions, especially as it relates to covered call ETFs. So let's simply look at an example. Now, we have to remember taxes are going to depend on a wide amount of variables. Everyone's situation is going to be different. But to start, let's look at an example with JEPI. Now, like we discussed earlier, the fund's benchmark is the S&P 500, but it does not hold all the names inside of the S&P 500. Inside, they hold roughly around 130 stocks their fund managers believe have attractive risk to reward characteristics. So again, that's coming into play. But because their fund does not invest into all the constituents of the S&P 500, they're forced to generate income by selling what's called equity-linked notes. You'll probably see the term ELNs. And to put it quite simply, these are taxed as ordinary income. So to look at an example, if you're in the top 25% of taxpayers in the USA, meaning your adjusted gross income is around $85 to $150K a year, then your effective tax rate would be around 17%. So if you're generating around $50,000 per year of income from JEPI, you'd owe $8,500 of that to the IRS. Now let's look at an example of SPYI. Now again, the key difference here is SPYI investors are buying all 500 constituents of the S&P 500, which means as the index adds and subtracts companies from their roster, investors in this fund will gain or lose exposure to those names automatically. And so unlike JEPI, SPYI writes covered call index options which are classified as Section 1256 contracts, allowing their income to be taxed more efficiently in the short term. The monthly distribution paid to SPYI investors is classified by the IRS as a return of capital. Now, we could have a whole in-depth video discussing return of capital, the pros and cons, but again, let's look at our example. Assuming you're a top 25% taxpayer, again, between $85K and $150K per year, and you generate $50,000 of income with SPYI, you could be expected to pay roughly $340 in ordinary income tax and $450 in long-term capital gains taxes. Obviously, this is a significant difference from JEPI. So what are the takeaways? Yes, it does look like SPYI has better total performance, larger distributions with less volatility when it comes to those distributions, and potentially for a lot of people it might be more attractive from a tax perspective. But there's one huge caveat to all of this that you have to understand. Like I said earlier, past performance is not indicative of future performance, and SPYI has certainly been the beneficiary of existing in a raging bull market. And in fact, they essentially launched their fund very close to when the bull market started. So the question absolutely remains, how will this fund perform when we do enter a bear market? Versus JEPI, who's been around on the block a little bit longer. We can see they were launched in May of 2020, so they endured the drawback of 2022 when the S&P 500 fell by almost 20%. And despite this, we can see when the fund was launched, it was trading at around $50 per share, but now it's sitting at about $57.43. So despite the market volatility, the bull market and the bear market that this fund has seen, it's still been able to grow its net asset value, which again is exceptionally rare for a lot of covered call ETFs. For example, I track whether or not funds grow their net asset value since inception in my covered call ETF database, and the answer for a lot of them is no. Again, you can download this for free at the link in the description. So personally, I've had a lot of fun tracking closely the performance of these two funds over the last few years, and a lot of fun tracking the performance of over 65 different covered call ETFs. Feel free to leave a comment in the description down below of which of these you prefer, and let me know if there's more funds or ETFs that you want me to cover in the comments down below. And if you want more research like this, be sure to check out dividendology.com at the link in the description, or you can simply scan the QR code that's on the screen right now. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.